Greetings, everybody. Welcome to Liberty Call. Today is Friday, October 4th, 2024. Hope you're having a fantastical day out there in the interwebs. Beautiful day here in Colorado. We're going to go out and get some sun and playtime with my main man, Jake, in a few minutes. So let's burn through the weekly recap and get on our way. So before we get started, if you could do me a favor, give me some thumbs up, a like, share, subscribe, follow, and press that notification bell. Alrighty, let's jump into today's numbers. Dow Jones was up 0.81%, 341 points, closed at 42,352. S&P 500 up 0.9%, 51 points, closed at 57,51. NASDAQ up 1.21%, 216 points, closed at 18,134. VIX down 6.25%, it's at 1921. Canada was up 0.81%, Brazil up 0.19%, and Mexico up 1.83%. In Europe, Germany was up 0.55%, the UK down 0.02%, France up 0.85%, Netherlands up 0.16%, Spain up 0.35%, Italy up 1.28%, Switzerland down 0.1%, and Portugal up 0.03%. Russian exchanges both green today. MOEX up 0.71%, RTSI up 0.88%. And the Asian markets, Nikkei in Japan was up 0.16%, Australia down 0.2%, New Zealand up 0.21%. Chinese markets still closed since the 30th. And let's see, the Hang Seng was open, it was up 2.82%, and the Taiwan weighted was down 0.39%. All right, so those are the markets. Let's bring up our chart and look and see how everything did for the week. Let's go to our weekly chart there. All righty. So starting out with the Dow Jones, looks like it's going to eke out a gain of 0.09% for the week if those numbers are accurate. S&P 500, same thing. Looks like it was up about 0.23%. The NASDAQ, oh wait, where is it? There we go. NASDAQ was up 0.12%. Huge week, guys. Dow Utilities, wait, there's the bottom of the candlestick from the previous week. It's going to finish the week down 0.41%, and the Dow Transport's going to be down about 2.25%. So the major indexes, up a smidge, but the more junior index is a little bit worse. So anyways, well, let's go back to the Dow and put in our trend lines back and take a peek and see how things are lining up right now. So, all right, so this was January right here, the beginning of the year. So we've been flat, big part of the year. I mean, a little bit of an uptrend. You can see here where we were bouncing off this trend line that started in about mid-April, and then, took a bit of a increase the trend line here, so we can see the bottom there, and it bounced off the bottom here just the other day. So if we go to the S&P 500, we can see where it broke the trend line that had started in mid-April, about, what was it, mid-July. It was in a downtrend and broke that downtrend here in mid-August. And you can see it's kind of like, whoop, bounce, and it bounced again. So what I'm looking for here is to see, are we going to break through this trend line with some significant downward force, or is this going to continue to trend upwards? So your guess is as good as mine, folks. I wish I had a crystal ball, but I have no idea. I have my own suspicions on what's going to happen just based upon everything else that's going on in the world. But I don't get the timing, unfortunately. So, all righty, let's get into the economic data for the week. Starting out with jobs. Initial jobless claims came in at 225,000, slightly above the forecast of 222. Previous number was 219. Continuing claims came in at 1.826 million. Previous number was 1.827, so down 1,000. There was no forecast for some reason. The ISM Manufacturing Purchasing Managers Index came in at a 47.2. Forecast was 47.6, so a bit below forecast, and it stayed the same as the previous. Construction spending month over month contracted at 0.1%. Forecast was 0.2% growth. Previous number was a 0.5% contraction. The ADP non-farm employment change grew by 143,000. Forecast was 124. Previous number was 103. Total vehicle sales came in at 15.8 million. Forecast was 15.6. Previous number was 15.1. So vehicle sales have been pretty steady this year. I mean, yeah, we've had a few months where it kind of dropped down, but the overall trend has been fairly flat this year. Last year was a bit up, and the previous year was down at the beginning of the year and then kind of flat. Factory orders month over month contracted at 0.2%. Forecast was 0.1. Previous number was 4.9%. ISM non-manufacturing purchasing managers index came in at 54.9. This is more like services and things like that. 54.9. Forecast was 51.7. Previous number was 51.5. Nonfarm, private non-farm payrolls grew at 223,000. Forecast was 125,000. Previous number was 114. And the employment rate, the unemployment rate came in at 4.1%, down from the forecast of 4.2. Previous number was also 4.2, so a smidge of a tick down there in the unemployment rate. The real unemployment rate, the U6 unemployment rate, is 7.7%. Previous number was 7.9. And the labor participation rate is static at 62.7. That was the same as the forecast and same as the previous month. All right, so that is the top line of everything. I mean, unfortunately, all that stuff looks pretty good. It's, when you start digging under the surface and getting into the, the smaller sectors and across those reports, that things don't look so good. All right, let's get into the market recap. Equities rise with dollar. Strong U.S. payrolls dampen rate cut hopes. Yeah, everybody wants more rate cuts. Global equity markets rose on Friday, buoyed by news of stronger than expected U.S. labor market data. MSCI's global equities index climbed, and the U.S. dollar reached its highest level since mid-August, reflecting investor optimism. The U.S. Bureau of Labor Statistics reported that 254,000 jobs were added to non-farm payrolls in September, significantly above the 140,000 estimate. This strong data, along with the lower than expected 4.1% unemployment rate, caused the U.S. Treasury yields to increase, with traders adjusting their expectations for future Federal Reserve rate cuts. The market now anticipates a 0.25% cut rather than a 0.5%. Despite concerns of a potential Israeli strike on Iranian energy infrastructure, oil prices rose for the fourth consecutive session. U.S. crude settled up 0.9% at $74.38 per barrel, while Brent gained 0.55% to close at $78.05 a barrel. However, oil paired some gains after U.S. President Joe Biden, if he is really the president, I think he's just a man in a mask, suggested that Israel might consider alternatives to attacking Iranian oil fields. So I say we stop helping and see how the chips really fall. All right, the dollar jumped to a 7-week high and posted its largest weekly gain since September of 22, driven by a robust jobs data and geopolitical risks. The dollar index rose 0.62%, with the euro down 0.57% and with the yen weaker by 1.27%. So normally you would expect when rates go down that you're going to have a weakening dollar. I mean, that's, in my opinion, why the dollar got so strong following the summer of, 2020, when the dollar was down around 90. It's because, we raised our rates, make the dollar more attractive because, it's, in their minds, a stronger currency. What I think is happening here is that the other currencies are getting weaker. We're not really doing anything. We're just kind of treading water in place like a dog. And, they're the ones, they got like weights attached to their feet and they're sinking. So I don't think it's necessarily that the dollar is strengthening. I think it's everyone else is getting weaker. That would be my guess. All right. Finishing up, U.S. Treasury yield surged with the 10-year note rising 12.1 basis points to 3.971%, and the 2-year note increasing by 20.4 basis points to 3.9176%, reflecting shifts in interest rate expectations. Gold prices fell as the dollar strengthened, with the spot gold declining 0.33% to $26.47 per ounce. That's still a pretty good number if you're holding on to gold. All right, so that's that. Let's jump into the September employment report from our friends over at First Trust. Mr. Robert Stein put this together. U.S. labor market showed strength in September, but with some caveats. Non-farm payrolls rose by 254,000, surpassing expectations, and prior month's figures were revised upwardly. Additionally, civilian employment, which includes small business startups, increased by 430,000, leading to a drop in the unemployment rate to 4.1%, the lowest since June. A core measure of job growth, excluding sectors influenced by government spending and regulation, such as education, health services, and leisure and hospitality, also showed solid gains with an increase of 64,000 jobs. Wage growth was strong, with the average hourly earnings rising 0.4% in September, up 4% from a year ago, outpacing inflation. Really? Doesn't feel like it. However, two concerning trends emerged. Despite job growth, a total number of hours worked in the private sector fell by 0.1% as the average work week decreased slightly from 34.3 hours to 34.2, meaning workers were logging fewer hours overall. Additionally, the median duration of unemployment rose to 9.9 weeks, the longest since early 22, suggesting it's taking longer for unemployed individuals to find jobs. For the Federal Reserve, this report reinforces the likelihood of a smaller 0.25% rate cut after the November election rather than the larger 0.5% cut. The Fed has made progress in reducing inflation closer to its 2% target, but given the lag in monetary policy effects, recession risks remain into the coming year. Yeah, I don't know if we're going to get out of this. They keep talking about that soft landing, but remember, the people talking about the soft landing were also the same people who told us that inflation was transitory back in May of 22. So looking at you, Janet Yellen, you moronic little owl. All right, last up from Zero Hedge, the Dockworkers were just the start. Other unions will now strike, expecting 62% wage increases. And this was written by Philip Mary of U.S. strategist at Rabobank. All right. Philip Mary, senior U.S. strategist at Rabobank, highlights ongoing market concerns surrounding developments in the Middle East and the anticipation of Israel's retaliation against Iran following recent tensions. Despite subdued oil prices, they are still on track for a weekly gain of about 8%. In domestic news, a significant breakthrough occurred as East Coast and Gulf Coast dock workers ended a 3-day strike after reaching a wage agreement with port operators. I guess everyone can return their toilet paper to Costco. The deal, which includes a 62% wage increase over 6 years, was brokered after the White House intervened. Yeah, it's good old government to come in and help things. While the wage hike is lower than the union's initial demand of 77%, it's a better deal than the one reached by West Coast dock workers last year. This agreement, which lasts until January of 25, raises the base hourly rate for dock workers from $39 to $63. Many are already earning over $100,000 annually. To move cargo off of ships, we could probably get some, take all these unemployed Americans and people on welfare, make them unload the damn trucks and planes and boats and everything. They got nothing else better to do with their time. Hell, we're paying for them to live. The resolution averts immediate supply shortages, but could lead to higher shipping costs, which will likely be passed on to manufacturers and the consumer. Yay. President Biden praised the collective bargaining process. Yeah, the man drools in his oatmeal. There's no way he's praising anything. Signaling his support for labor unions. Of course, he loves unions. They're just small government on top of a business. His administration's stance, similar to what a potential Harris administration might take, could encourage other unions to pursue similar demands. Meanwhile, Israel's ongoing invasion of Lebanon has sidelined Biden's involvement in the Middle East as Israeli Prime Minister Benjamin Netanyahu leverages the U.S.'s focus on upcoming elections. Mary also touches on the latest ISM services survey, which revealed stagflationary signals. The survey showed a rise in prices paid index, reflecting inflationary pressure, while the employment index fell into contractionary territory, complicating the Federal Reserve's balancing act between inflation and labor market support. All right. Well, that's it. That's all the news for the week. Y'all feel smarter out there? I know I do. All right. Well, if you need anything from me, please go to DSAFinancialGroup.com. That's where you can go get all your financial planning needs addressed. Hope everyone out there has a wonderful weekend. I shall talk to you again next time. Adios.